We begin by understanding just what we mean by carbon accounting. Now, you should know that carbon accounting is a critical component of environmental stewardship. It offers organizations as well as individuals a structured approach to measure, to manage, and to report their carbon emissions. Now, in a world that is increasingly concerned with climate change and environmental sustainability, carbon accounting plays a pivotal role in helping us comprehend and address the impact of human activities on this planet. Carbon accounting is often referred to as carbon footprinting, and it is the process of quantifying the total amount of greenhouse gases, the main one being carbon dioxide, that has been emitted into the atmosphere as a result of human activities. These activities can range from industrial processes and energy consumption to transportation and waste generation. Carbon accounting involves measuring, monitoring, as well as reporting these emissions. First, there is climate change mitigation. That is, by understanding the carbon footprint of various activities, we can identify then opportunities to reduce emissions. First, there is climate change mitigation. That is, by understanding the carbon footprint of various activities, we are then in a position to identify opportunities for reducing emissions. This information is vital for mitigating climate change and achieving international climate targets, like those outlined in the Paris Agreement. By identifying and addressing these inefficiencies, a company can achieve cost savings as well as improve resource management. Also, there is the issue of resource efficiency. By tracking carbon emissions, we can reveal areas of inefficiencies in an organization's operations. Identifying and addressing these inefficiencies can lead to cost savings as well as improvement in resource management. Then there are stakeholder expectations. That is, shareholders and customers and other stakeholders increasingly expect transparency and accountability regarding an organization's environmental impact. Carbon accounting helps meet these expectations. Why? Because it can provide a competitive advantage to organizations if they can demonstrate low carbon emissions and a commitment to sustainability. This can assure investor confidence. Many investors consider an organization's environmental performance when making investment decisions. Therefore, carbon accounting can provide that data to enhance investor confidence. Next, we examine just how does carbon accounting work. Well, carbon accounting is a systematic process that typically involves the following steps. Emission factors are used to convert activity data, for example, the number of miles driven, into CO2 equivalent emissions. These factors are typically provided by environmental agencies and are specific to various activities as well as fuels. Different greenhouse gases have varying global warming potentials. Organizations are often required to report their emissions to regulatory bodies, industry bodies, and the public. Once a company is armed with a clear understanding of their carbon footprint, they can then develop strategies to reduce emissions. These strategies may include improving energy efficiency, adopting renewable energy sources, or optimizing transportation systems. You should know that many organizations today hire independent third-party organizations to verify their carbon accounting data. In that way, they can ensure accuracy and credibility. Next, we look at the challenges facing an organization in carbon accounting. While carbon accounting offers numerous benefits, it also comes with its share of challenges. First, there is the issue of data accuracy. That is, ensuring that the accuracy of the data, especially in a complex organization with multiple emission sources, can be challenging. Another major issue is the definition of the scope and boundaries. By defining the scope and boundaries of the assessment can be very subjective and complex, making it difficult to compare results across organizations. Another problem may be the emission factors may not be available or may not be accurately representing local conditions, leading to uncertainties in the emissions calculations. And that is because it provides a company with the necessary data as well as insights for organizations and individuals to measure, to manage, and to reduce their carbon emissions. The fact that carbon reporting regulations can and often do change over time, this requires organizations to stay updated to adapt to all these new requirements. Carbon accounting is a fundamental tool for addressing climate change as well as promoting environmental sustainability. And that is because it provides a company with the necessary data as well as insights for organizations to measure, to manage, and to reduce their carbon emissions. While these challenges exist, still, the benefits of carbon accounting, including improved resource efficiency, as well as cost savings and a competitive advantage, still make it an essential practice in today's business world. As we continue to grapple with the consequences of climate change, carbon accounting will play an increasingly significant role in shaping our response to this global challenge.